Hello and welcome to Beyond the Pivot, the podcast where we bring you honest, unfiltered journeys from Africa's entrepreneurs and innovators.
I'm Kabwela Malupande, joined by my co-host, Martin Vitek. Each episode, we dive deep into the realities of building and growing businesses on our continent. Let's get started. This is Beyond the Pivot. Hi, everybody. Welcome to the Beyond the Pivot podcast. Our guest today, an amazing guest in the entrepreneur circles and ecosystem, is Brad Magrath, a seasoned entrepreneur, investor, and one of the leading voices in Africa's early stage venture landscape. Brad is a partner at AHL Venture Partners, one of Africa's pioneering early stage impact focused funds, and has invested in over 40 companies across the continent. AHL is known for backing entrepreneurs solving essential problems in financial inclusion, agriculture, healthcare, and climate resilience, and doing it with a long-term catalytic mindset. I also have to mention to anyone listening, Brad is also a local superstar in the entrepreneurship ecosystem here in Zambia, as he has gone through all the stages of entrepreneurship development, from startup, growth, failure, pivoting, and also being acquired, which is an exit by cheaper cash, and all of that good stuff which we'll be talking about today. Brad, welcome to Beyond the Pivot.
Really good to be here and good to break bread with both of you.
Amazing. Brad, to get us started, while we were researching you, I think something came up which was quite interesting. It's something recent which you're working on. It's a walk in the forest. It's quite unconventional and an unconventional way of meeting people. And we just wanted to hear about that. What's happening and why did you choose exactly to just take a walk in nature with entrepreneurs and other people in the ecosystem?
Yeah, so I think a lot about the quality of relationships and shifting relationships from being transactional to being in service. I also think sometimes we can get stuck in boardrooms where we're dealing with an individual transaction or an individual issue. Whereas if you want to build a community, if you want to build an ecosystem, the value of being able to get out of the office, to have a beautiful walk in a beautiful forest. We're very fortunate here in Nairobi to have such a wonderful forest in the city center, and really just to meet as humans, whether you're an entrepreneur, an investor. There's no agenda, there's no mandate. It's just you arrive with your trainers, your water bottle, your phone if you want to take a photo. And it's just trying to build out a community where we talk openly, generously, and candidly about our ecosystem and what's working and what's not working in just a very open, transparent way.
Have you
And I have to mention
noticed-
to anybody thinking about it as well, it's a 5 to 6 kilometer walk. So please be prepared and train for it. Martin, please go ahead.
I just was wondering maybe if you saw a change of people's thinking, when they are in the nature compared to the boardroom, as you said. So, is those topics of conversations different?
Yeah, I think so. I mean, it's. I've also been doing this with individual founders for a while, and it's really just about how do you build trust and relationship currency, and how do you do it in a way where there's no agenda or no meaning other than to listen, to be curious, to ask questions, and basically to learn. I think in every engagement, all parties are always learning from each other. If you ask questions and then listen and communicate actively, not only with your mouth, but also with your ears.
Yeah, I just wanted to mention, Brad, you talked about two things right there that I would like to double click on, which is trust and relational currency. Why are those two things important?
So I think if you think about it from an entrepreneur point of view, the ability of people to trust you, whether it's your customers with their hard-earned money, whether it's your team with their talent and their career, whether it's investors that are trusting you with their money to get you a return on investment, whether it's the regulator that knows you're going to do the right thing under pressure, whether it's lenders who are you're committing to borrow and repay money. So I think that trust is crucial. And then I think in terms of relationships, I think I'm a fundamental believer that happiness and success is often built on the quality of your relationships. But relationships require honesty, they require candor, They require robust, challenging conversations. They require clarity, alignment, transparency. So I think whether you're in a boardroom or walking in the forest, um, I think these fundamentals are key. I think the other thing whenever dealing with people is I always assume good intent, and I also assume I'm dealing with a highly competent, capable person. So when you can build these relationships out of the office, you might know when it's someone's birthday, what their hobbies are, whether they've got kids. It just allows you to be human when it matters most. Because a startup and a scale up is never a straight line. There's always going to be potholes. There's always going to be challenges. So that ability to be able to have currency or trust currency in the bank when you're dealing with big problems or you've got an opportunity to maximize a big potential opportunity. I just think that relationship, and when I say relationship, it's not just about being friends. It's about being able to have really radical, candid, tough, challenging, but also supportive conversations at the right time.
And is this a lesson that, is it something that you've always embodied, or it's something that you had to learn the hard way? I'm just curious.
I think in some ways it might have been a little bit of my transition from being an entrepreneur to an investor. As I think as an entrepreneur, you're very much accountable and have ownership of outcome. As an investor, it's a lot more about creating influence and relevance in a supporting, challenging role for the entrepreneurs. So I think all of our lives and our business journeys are a journey of self-awareness and self-development. So in many ways, this is probably me at a later stage in my career, getting a bit more mature, getting a bit more intentional around how to show up in service of the people I'm engaging. And really, I do think ultimately it's always about the right outcome, not being right. So how do you develop the sort of pattern recognition and the muscle to have the right conversations in the right time, in service of the right outcome for the business, the right outcome for the investors, the entrepreneur, and that does require you to put your ego aside and really focus about what is needed for the business rather than what you may or may not think is right or wrong in that moment.
Does that stem from childhood, this like passion to build and lead people? Because I'm sure there's people around you, just like around me here, that building is too much work, too much responsibility or something. So you have to be kind of a character, or maybe even groomed to it. Where this passion for building and also kind of being around the startup ecosystem came from?
So, interestingly, I was born in Zambia. When I was 7 years old, my parents got divorced and my mum moved to Singapore. My dad stayed in Kitwe. I went to boarding school in South Africa. So for those years, I was exposed to, different cultures, different ways of working, different ways of being, different stages of growth and development. And I think out of that probably came a humility and a commitment and a drive to grow and build things. I think both my brother and I, who were business partners, were always problem solvers. And I think we were always very intentional about solving problems that, one, could have a positive impact on communities, but two, could be sustainable, profitable businesses that could grow and scale. Yeah, I think underlyingly, I think there was always a conviction to build, a curiosity that we didn't know the answers when we started to build. And then I think maybe linked to my upbringing, I think there was always an awareness that you had to do it with the people around you. How do you create tribes around you of good people that are aligned with your why, that have similar values to you, that are low ego, that want to do great work? High performance is a choice. The ability or the willingness or the sacrifices to make a choice to be a high performing team and a high performing business is very intentional. And then I just think maybe the blend of growing up in these places and my track record as an entrepreneur, now an investor, is I always had an underlying philosophy that entrepreneurship and technology could fundamentally leapfrog Africa forward. It was at the core of everything I thought about when I thought about going into business by myself. And then equally, it probably took me a while to underestimate what a privileged capital was, and then how do we unlock more capital? Because talent is universal, opportunity isn't. So how do we unlock more capital? So I think that capital is key, but I think the longer I've stayed in the game, increasingly important to me is also how to increase the strategic influence of the entrepreneurs who are getting this capital. So it's not just about capital, it's about widening the voice and the influence and the relevance of entrepreneurship and entrepreneurs in Africa. Ideally, with the goal being, as soon as we have more second generation entrepreneurs who've exited businesses that become investors, there's more empathy, understanding, credibility, supportive challenge. But capital is just such a critical thing. And then I also think, we all need to be mature and responsible, that capital only comes if you, as Africa, can show that we can realize and deliver risk-adjusted returns for financial investors. So risk-adjusted financial returns, positive impact. We've got to show this responsibility that, you deploy capital, you get a return on it. We do that, more capital will flow.
And when did the entrepreneur path become real and tangible for you? Was there a specific moment when you just decided to say, hey, I think entrepreneurship is for me, or something that led you to that?
So interestingly, I'm old enough that when I started my entrepreneurial journey, I don't think the word entrepreneurship was well known. So I don't know if you remember, you have to go through passport and you had to write what your occupation was. And I always used to write self-employed. But the first time I wrote entrepreneur, not self-employed, I felt like it was a step forward. I don't know if I spelt it right, but it did feel like a step forward. So I think from a young age, I always had a side hustle. Like when I lived in Singapore, I would bring back stuff to South Africa to sell. When I went home to holiday in Zambia, I'd bring back stuff to sell at school. But I think it was just a phone call with my brother and I where, we sat down and we looked at the time at Zambia. I think financial inclusion was 8%. Formal employment was really challenging for young people to get. And when we started to think intentionally about what Zoona might be, it was really about thinking, how could we potentially fundamentally change the way people transacted in Zambia? I think when we looked at, and we started with a rural cotton farmer, 30% of their income went to just doing a single transaction, like to buy or collect money for something. So I think at that stage, going back to entrepreneurship, technology, the advent of mobile technology, we really felt the infrastructure was there to fundamentally do things different. So we always wanted to do something that would have positive impact, that would be commercially sustainable and hopefully successful, but also something that could scale. So I think it was probably driven along those lines.
I have to say it's one of the toughest sectors to be in, the social impact business, because you have to combine showing not just the impact, but also it has to work, right? It has to be the business that makes you money and your investors money. So what kind of thinking led you to it? I assume that you saw the issues around you, and one thing is to see the issues and find a solution for them, but second thing is to actually name it, right? Like, find proper indicators to track and so on. So could you maybe expand the story on like how were you thinking about Zoona when you were starting it, what it is, and also what kind of indicators you were tracking that you are actually improving the situation but also making money in the same time, so it didn't turn into just another NGO?
And
Yeah,
Brad, I want to add to that question.
Yeah,
I just want
please
to
do.
add to it because for context, at the time you were building Zoona, tech startups wasn't even a thing in Zambia, right? And so we're curious as well, like at that point, how were you thinking about your talent that you were hiring? How are you going to build this whole company? So maybe if you could just add to that as well.
Yeah, it's a long time ago now, and 0 to 1 is incredibly hard. So anyone starting a business has my huge respect. I think that we didn't have the answers. We didn't even know some of the right questions, but we saw an opportunity. We built a technology. We built an airtime distribution business in Bangladesh and Malawi of all places. And that technology was the foundation of which we then applied to build out the functionality of the Zoona platform. But ultimately, I think we saw a big enough opportunity that inspired us to just go and learn by doing. And I think if I'm 100% honest, we were not driven by impact in the beginning. We were driven by making money. And one thing I think that we did very well in the beginning, and I'd encourage all entrepreneurs to do, is we very much saw our customer as our cheapest form of capital. So very early on, we tried to build out a customer value proposition that people would pay for, and they'd pay us more for it than it cost us to deliver, so that we could build out cash runway, so that we could reduce burn, so that we could, go on this journey to get enough traction and credibility as a team to then go and raise capital. Martin, in terms of the impact question, it wasn't until much later on that we started to articulate or narrate our impact. And that probably came through the people we started to hire, because interestingly, when you're hiring people that accept below market wages, the why they work is very important to them. So, we started to attract really talented people that weren't purely driven by financial compensation. They were driven by what we were trying to do. And then as we started to raise capital from impact investors, we had to start to formalize. But one thing we try to be very clear on and very open and transparent with our teammates and with investors is that we didn't do impact. We ran a business, and by doing what we do, we had impact. And I think for us, it was a fundamental difference. We had impact by what we did, and what we did was building a sustainable, profitable business. But we didn't do impact first and foremost. There is a role for that, but it wasn't our competence and it wasn't our direction.
If you're enjoying this episode, take a second to like, share, and subscribe. It helps us reach more people and keep these conversations going. Thanks for your support.
I love that you mentioned that it's business first. A lot of people put impact first, and then they are not having a business, but just an NGO that is not sustainable, let's say, because it's depending on grants or somebody else's benevolence. And I also, Kabbalah taught me a term called camel, that African businesses need to be camels, be run by their customers. So I believe that it also has to be have an impact on how you build that business, because you have to listen to the customers way more. Could you perhaps expand on that, how that affected the journey of Zoona, like where it was heading when the customers starting to pay, and maybe they were influencing how your decisions were made in the end?
Yeah, I think before you become a camel, you first have to be a cockroach. In Africa, I think you just have to survive and not die, because we don't have an effective angel investing network yet. So I think a lot of entrepreneurs really have to work hard to get there. I think the beauty of Africa, again, before camel, is this concept of the zebra, where you've got the black and white stripes, which is both purpose and profits. So they both sit there together. I think the customer one is a really important one, because I think entrepreneurs that have local context, that are deeply ingrained and connected to the problem they're solving, have sufficient customer empathy that they're solving the right problem in the right way. And I think whether you're going to have long-term impact or deliver long-term financial results, ultimately you need to deliver value to a customer that they're willing to pay for. And I think whatever businesses I've been involved in, or whatever businesses I've invested in, when that real customer intimacy is aligned with a strong profitability mandate and a decision-making framework that drives for sustainable growth alongside impact, good things happen. But I do think there needs to be that real empathy and understanding of customer, but with a strong executional DNA, and then a strong decision-making framework and mandate to become profitable. Because I do think more than anywhere else in the world, you have to stretch your dollar further in Africa. If you want to scale into a new market, it's not as easy as scaling across America or across Europe. Every market has its unique regulation, cultural, capital challenges. So you really do have to stretch your dollars, and you have to take this sort of camel methodology that you need to go a long way with a little. And so much of that then is at every stage of growth, really delivering customer value that drives revenue at good margins down to bottom line profitability. So there also is a responsibility to maintain your lean and mean costs, to be sensible around your working capital cash flow cycles. So I think part of being an entrepreneur in Africa is just really embracing the scarcity, and scarcity can breed innovation, and just being very intentional around your capital structure and your capital focus. Because also sometimes if you raise money, there's a pressure to spend, there's a pressure to grow, but you also need to make sure that that's done with the main customer in mind. And that's, again, going back to Zoona, you're scaling yourself, you're scaling your business at various stages. We didn't do that well. So there's always lessons to learn, and there's there's always gray hairs around your career.
And Brad, so I'm curious about two things. So what was your primary source of capital with Zoona in the initial phases? Since, like you said, it's quite difficult to access capital within our ecosystems. And for those that do not know, what was the full scale of Zoona when it really grew? So that they just have context as to what you had built as well.
So maybe at context, we had across the continent, we transacted more than $5 billion. I think in Zambia, we had 4 million active 30-day customers. We paid out, I think, $400 million in agent commissions. We raised a 4 million Series A, a 15 million Series B. We exited two strategic partners. And the business itself continues to grow and flourish more as a B2B business than a consumer business. I think, interestingly, I don't think we ever really wanted to be a consumer business. We wanted to be a B2B business, but at the time in Zambia, when we sort of cracked the agent model and the money transfer model, the customer demand was just, it just grew and grew and grew and grew. But it was never the sort of the core competency that we thought could scale across the continent. We always felt that we wanted to build a B2B business and be the back end plumbing, which is effectively now what Zoona and Tilt is. But we were solving a very real customer need at the time that served a real purpose. And I think also, if I think about it, like, when I went to raise our Series A, I flew across to America. And at that stage, all of the investors we were talking to were based out of Africa. If I look now, every investor that invested in Zoona, it was their first investment in Africa. And every one of those funds now has an office in Africa, which in many ways is very, very catalytic. And equally, another thing I reflect on is so many of the early employees of Zoona have gone on to do incredible things, starting funds, starting their own fintechs, working in some of the scaling fintechs across Africa. So, I think there's so many lessons and learnings about being a pioneer. And then going back to the first part of the question, which was around how do we scale it? I think my brother and I were fortunate. We both came out of corporate jobs, so we had some savings. We also, at various stages, had sort of family and friends networks that we could lean on. But we were also very scrappy around doing bespoke projects to get cash into the business. We built a voucher system for the World Food Program. We built a voucher system, or fertilizer voucher system for FAO. So we pretty much did what we could to get cash in the business until we were able to prove out this customer value proposition and were able to generate sufficient revenue to be sustainable. Because we didn't want to go and raise a Series A if we weren't profitable, because we felt we needed to, and times were very different then. There weren't the level of funders in the market that there are now. So we had to get people to jump on a plane from Washington or New York or San Francisco to come to Lusaka. So we wanted to be a good enough business that not only would we get them to come to Zambia, but we needed to convince more than one of them to put in an offer. Because if there was just one, we'd have to accept their terms. If we had multiple investors, we could negotiate terms more effectively.
That's brilliant. And while you scaled to that height, Brad, there's a point, and I'm dwelling so much on Zoona before we even move on, because I think there are quite some valuable lessons there for many founders, right? While at the height of that success, and I think you did an amazing job, there was some level of disruption that came into the market, right? Now we had Telcos coming into the market, competing directly with Zoona. And I think there I would like us to speak to how founders can deal with competition and how exactly they can reposition themselves for success and growth. Could you tell us about that instance when this disruption was happening? We have Telcos coming in with more mobile money and competing directly with Zoona.
Yeah, look, I think there's always opportunity and challenge in being a a pioneer. I mean, the opportunity is you've got blue ocean, you get to swim first. The challenge is you're building verticals, you're building horizontals, you're educating the market, you're engaging with the regulator. The more successful you are, the more you crowd in other players. They see the addressable market, they see the opportunity. I think that outside of competition, we were also going through a lot of challenge ourselves. We were scaling across markets. We'd raised a lot of capital. We were opening new markets. We were launching new products. And ultimately, we then were competing with a very well-funded competitor with what ultimately then became a better consumer product than we had at a more affordable price for the consumer. So I think in hindsight, I think we should have focused more. We should have doubled down on our core competencies more. We should have really thought about where we could outcompete the networks and where we couldn't. And I think the mistake we made is we raised a lot of capital and then we expanded into new markets before we'd really shut down Zambia. And then we also took on a lot of fixed cost. We had a lot of people. So I think a lot of what made us a very good Series A and B businesses, we actually found quite challenging at Series B and C. Yeah, because ultimately scale, going from 0 to 1, 1 to 10, 10 to 100, are all very different elements. You don't run a family the way you run a town, the way you run a city, the way you run a country. And as first-time founders, we were also making mistakes in our own. But I mean, 8 years down the line, MTN and Airtel are some of Zoona's biggest customers. They're channel partners. So I think, they're all lessons in how you go about building and scaling, and probably learning to better understand where you compete and where you collaborate as the market becomes more competitive.
So to summarize, you built Zoona, you exited, so now you were a happy guy with your brother, you had some money in your bank, and that was a decision where to go for vacation, I suppose. And after the vacation, there was a decision whether to build some more businesses, perhaps, because you were still a young guy, so it wasn't no time for retirement, or whether to build that fund that you built in the end, the AHL. So what kind of like influence the decision, the leaning towards building more businesses compared to maybe focusing on the fund itself?
So I think the first thing I would say is I think there's a real cost to being an entrepreneur. So by the end of Zoona, for me personally, well, my end, not the business end, the business continued and did lots of things. When I exited, I was tired. It had been a lot of work. I think as an entrepreneur, sometimes you're selfless to your business, but that means you're selfish to your loved ones, to your kids, to your wife, to your health. So to be honest, I took some time out after Zoona. I spent some time just reflecting on what I wanted to do and what I wanted to think about. I then actually joined Africa Leadership Group as an entrepreneur in residence, really just thinking about helping them to go on their journey of scale. So the work I was doing there was, how to think about how we could develop, train, and upskill African software engineers to effectively sell their services outside of Africa, to have training in Africa, and then dollar incomes coming back to Africa. And at that stage, then I was approached by AHL, who were actual investors in Zoona, and they were sort of Razan, the CEO, just sat me down and said, I'd like you to join the fund. And I was like, I'm not an investor. Why would we do this? And she'd obviously worked with me as an entrepreneur and just felt that having an operating partner who built and scaled and exited a business could support in terms of building bridges with the portfolio, having the good, solid conversations with the portfolio. And equally, I think something we never should underestimate is funds themselves are startups. So Razan was also building out and scaling this fund. So working with her in terms of how do we think about operationalizing and scaling the fund, but then also, how to think about how I might be able to add value to our portfolio. And I guess, I'd had experience about scaling building and scaling a single entity business. But it's been a real privilege and something I'm very grateful for, that as an investor, you get to see a much more horizontal view. You see multiple businesses, multiple founders, multiple products, and it's a real privilege to be able to engage with the founders. And again, as a founder, you have a lot more individual ownership and accountability to income. As an investor, it's much more, how do you build influence and relevance through relationship, through engagement, that you can both support and challenge the founder and the business at the right times as they now go through their scale journey.
And is that a journey that you see for founders, hopefully if they're successful, that they go through the phase of building and come back full circle as entrepreneurs, as investors, to come back and invest in other startups as well?
I would hope so, because I do think that I've learned so many good disciplines being in an investment firm and working with my investment partners, like so many incredible disciplines. But I think having walked on both sides of the fence, I think there is real value to having entrepreneurs that have built and scaled in Africa, being part of the ecosystem as funders. And I think we've learned lessons from other markets that that is a model that does work. And I think the lessons you've learned, the scars you've had, as long as you don't let the scars diminish your enthusiasm, I think it's a very valuable trait to bring to the table. And equally, every founder that becomes an investor will, just as you have to learn to be a good founder and scale up, you really do have to learn to be a good investor. So much of my journey here at AHL is just the humility and curiosity to constantly learn, to constantly ask questions, and to constantly grow and adapt as an ecosystem player.
You are truly a citizen of the world. You already mentioned you lived in South Africa, Zambia, Singapore, now in Kenya. So I'm wondering, are there any policies in place that makes this decision for like exited founders easier to become investors? Or is it, I've worked so hard, like you mentioned, it took a toll on me. Are you gonna just buy a house in Maldives and spend it on the beach? What do you think is that motivation over time? That bug that keeps on bugging, and is it actually made it easier by the policies, or is it despite the policies people are doing it?
So I think your individual and collective why matters to me. So why do I do things? I think before I do anything, I probably ask myself a few questions. Am I uniquely positioned to add value to this opportunity? Am I going to be working with exceptional people that will challenge and motivate me? Am I going to be solving problems that matter? And I think increasingly, if Africa is going to win, we have to get the right capital onto the continent. Increasingly now, I'm probably motivated by, how do we generate risk-adjusted returns and impact that bring capital onto the market? And how do we increasingly give the entrepreneurs and the entrepreneurial ecosystem more influence and relevance to co-create this ecosystem? So I don't think anything I've ever done has been motivated from a sort of a single dollar on my paycheck at the end of the month. I think it's much more motivated by, I do want to be compensated fairly, but more importantly, how do we build out the financial markets and the capital markets and the ecosystem that the incredible resilience and talent and hardworking entrepreneurs that are out there are supported in the right way. And I think part of that support is potentially really thinking about how, copying and pasting venture capital models from, let's say, Silicon Valley don't work here. So what do we need to do to build out capital markets, capital investments from the early stages to the seed stages, to the growth stages, to the equity exit stages that supports the ecosystem? Because building a business is incredibly hard. Finding a customer value proposition, delivering value to your customer, building out the team and the business model, the board, the capital structure, all these things are incredibly difficult. So I think increasingly, how do we also support the right capital at the right stages for business as they're going on this growth journey?
What are you seeing as some of the things or methodologies or processes that are working for Africa in comparison to like systems or methods that's that have been established in the West or East? What are you seeing is working currently in our ecosystem?
So I think increasingly you're starting to see a lot more debt coming into the market. I think a lot of that is potentially around some of the challenges around exits. But then again, if I think about how we look at debt, we probably look at it absolutely must be fueling growth. It's not to cover overhead. It's not to cover capex. It's how do you fuel growth? So yeah, we do a lot of working capital debt, which is how do you accelerate your growth by being able to invest more capital into your machine. We've also done quite a bit of bridge debt, which is often where a business is going towards a capital raise, but maybe the capital raise is taking a bit longer, it's a bit more complex. Injecting a bridge debt can really help them accelerate their growth into that raise so they can ensure they raise on good momentum. And then also mezz debt, where maybe for some entrepreneurs, they haven't built out the traction that allows them to get an equity valuation they want. So how do you layer on a mezz debt so the founder is not diluted, but the business still grows and scales? I think the real opportunity is to think about how do we crowd in local capital, like pension funds, and then also how do we hopefully support founders to exit so that you have local entrepreneurs with real understanding of local markets coming in to support some of the early stage angel and seed investors.
We've seen other firms include things like founder support, where they'll include an embedded program. Is that something that you do as well? What does that look like while you provide the working capital to fuel the growth?
Yeah, I think a lot of ours is in the early stage. We really think about how to help the founder grow the business. So we work with IMD Business School out of Europe to provide our entrepreneurs with business courses out of IMD. It's a business school. I think it's in Switzerland. Yeah, Switzerland. We work with Art of Scale, who provide scaling workshops with our portfolio. It's something we worked with them at Zoona, and it really did help us create the clarity and focus and discipline and prioritization to scale Zoona. So we work with Art of Scale. We also work with a company called Razi, who do digital customer surveys across the continent. So really helping founders think about new markets or new products or understanding their competition better. So the early stages is often really about sales. It's often a very underestimated element of early stage scaling. And then later, we probably start to think a lot more around governance. What does good governance look like? What does good decision making look like? What do exits look like? We also probably then also start to think about, you've built something of value. How do you preserve it? What are your risk managements? What are your risk mitigations? And then maybe going back to one of the earlier questions Martin asked, I think as businesses start to scale, especially commercial businesses, they haven't always intentionally thought about the impact they're having. So actually helping them think about, this is some of the impact you're having. These are the KPIs at a granular level that are having real impact. And by then unlocking that narrative often helps them raise additional capital and go on their growth journey. But I think for most of us in the African markets, you very rarely at an early stage investor going to be paid out of an exit, or even as a lender be paid out of free cash flow. So all of us are looking to build capacity in the business we're investing in. How do they get to that next level of growth that's going to unlock the next level of investment? So I think it's all about how do we think about growth? And at early stages, that's probably sales and marketing. At later stages, you've got to start thinking about risk, regulation, governance. So you're not only growing, but you're also preserving the value you've created as a business.
You have mentioned exits several times as there need to be one, so that there is the risk-adjusted returns for the investors from Africa, but also other continents. And I noticed in the last Africa deal book, I think it's the data bank, that there were 2 IPOs, one from South Africa, one from Morocco. And I was just wondering how often actually businesses exit through IPOs, or is it, like you mentioned also in the previous sentence, is it more like, strategic partners buying it out, or like the seed investors are being bought out in the seed A round? How does it usually work out, the exits for people who invest in various stages?
So I think one thing, I mean, we had a successful exit at the end of this year, a $10 million exit, which was part of a secondary. So I think increasingly we're starting to see secondary exits where people are going, we've supported the journey, we've invested in the journey, we're now exiting the journey. that means you're potentially leaving more upside for someone else to take on and grow, but I think that's healthy. So I think investors getting more intentional around when they exit. And so I think secondaries are an option. I think strategic acquisitions are increasingly an option. And then I do think, across the fintech world and across the e-mobility world, I think we are going to see some convergence. And how do you make sure then that 1 + 1 = 3 as you look to combine businesses? But I do think you've got to be incredibly creative around exits, and you've got to be incredibly intentional around them. And I do think even, when founders and investors talk, even before exits, before investment, they should be talking about exits and understanding what the journey is. I mean, without breaking it down to be too simple, because it's not simple. A lot of what I think about is when you're looking at investing in a business, where is the business today? And I'd always encourage entrepreneurs to be 100% transparent. No investor expects your business to be perfect. Like, they will understand if you've got an outstanding tax liability because you had to pay Amazon card services to keep your product up. They'll understand it, but they'll only understand it if you're transparent about it. Equally, they'll understand if you've had a fallout with your founder, or you've got an early angel investor that needs to cash out. But where your business is today, just be 100% transparent with your potential investors. And I wouldn't treat them like forensic auditors. I'd treat them like free consultants. Let them come in and look at your business. Let them tell you what's right, that's wrong, and then try and make them part of the solution to set you up for that next stage of growth. I think the next step is just to align with your investors where you're going, because again, this comes back to that exit conversation. If you're all going in the same direction, that alignment is critical. If there's misalignment and you want to go in different directions, that's not great. And then the third one is just, what's your plan to get there? Because ultimately you need someone's capital to scale and grow, and they need to see a credible plan that they believe you will execute on. So if you can get aligned on where you are today, where you're going, and how you're going to get there, of course, by the time you get to term sheets and contracts, it's a whole lot more complicated. But I think those fundamentals, if you can align around those, and there's credibility around the execution. I think I mean, I only can speak to Africa because that's where I've had most of my career. But the most successful businesses are the ones that have an executional DNA and have a high performance culture that they execute to drive sustainable growth, customer value, shareholder returns. That executional DNA and discipline is just so critical.
And to speak, I think we've talked about the founders and the exits as you're having those discussions. And right now, fintech has had quite a lot of attention in Africa, as it's one of the sectors that's highly invested in. But what sectors are you seeing currently, or business models in Africa today, that you feel are still being underinvested? And that these might even potentially have like high potential for social impact and investor returns.
So I think fintech has been invested in significantly. I think certainly on the payment side, I think there's going to be a lot more investment in embedded finance, and I think the where that market will shift, I think, will be interesting. I think we cannot be in Africa and not talk about agriculture, and the opportunities for processing, for export. So we had a new partner join us who is an agric expert, and it's been so interesting for me to see where I potentially, because I don't come from an agriculture environment, I wouldn't have seen the opportunities where he does, and it's been a very refreshing for us to start to be able to diversify away from our heavy reliance on fintech. So I think agriculture, processing, exports. I think smart climate or action climate, I think there's so much opportunity and investment there. And then I do think with the shifting in technology, I think there's such an opportunity that health and education could become way more commercially successful. And there you do have real impact. So I think agriculture, action climate, but also I think health and education. I think it's a real opportunity to solve real grassroots problems that can scale with commercial sustainability.
If you are enjoying this episode, take a second to like, share, and subscribe. It helps us to reach more people and keep these conversations going. Thank you for your support.
Do you only look at technology startups with technology at the core of their businesses, or do you consider SMEs and traditional businesses as well? Because I heard you talking
So
about processing and exports.
Yeah, we're not. So, for example, in Zambia, we're an investor in Java Foods, the noodle manufacturer. So we're an equity investor there. So we're not driven by tech, and I think sometimes we promote tech, whereas I always ask, does the tech solve a real customer pain point, and is the tech what the customer really needs and wants to pay for? So I do think as we think tech, we really need to be disciplined about that. Certainly tech does allow you to scale exponentially and go to that last centimeter distribution. So I do think there's a lot more opportunity there. But no, it doesn't have to be tech. And if you think about it, pretty much all businesses going forward will be tech enabled or tech embedded in some, like every time you pay for something on your smartphone, or every time a business that's selling something receives an electronic payment, it is in the tech ecosystem, even if not as an active initiator. They can jump on those rails. And I think, I mean, living in Kenya, I've not touched cash in 4 years. Like, I've literally not touched a cash note because everything runs on M-Pesa. So, if you're now starting a business and someone has fully solved the payment problem for you, that allows you to solve a customer problem in a new and unique way that you wouldn't have been able to 10 years ago.
And I'm sure you're getting so many pitches, so many founders trying to get your investment. How would you say that for a startup to be successful, let's, be in fintech, agriculture, or clean tech, how should they prepare for you? How to increase their own chances to get from a mailbox to actually in front of you on the table, at least that you print out their pitch deck. So it's interesting.
So I think I think you need to build out your networks. And I think in Zambia, I look at someone like Bongo Hive and the work they're doing. You really, as an entrepreneur, need to crowd into these networks, and you need to go and find out where are the conversations happening and try and get in that room. Because if I'm honest, there's very few investment funds that would, like, a cold call email is very unlikely going to get you into the room where the decisions are made. So I think you whether it's fair or unfair, it probably is unfair, but you really do need to look at your entrepreneurial ecosystem and the market you operate and plug into that. So plug into the entrepreneurs, plug into the investors, plug into the ecosystem and enablers and the accelerators, etc. So you become part of that community. And in some ways, that was sort of some of the foundational elements of, anyone is invited to the walk I do on that Friday morning at Karura. You just have to show up. So I think that ability to show up and talk to someone face to face and build a human relationship with them is important. I think just be very intentional around understanding what type of capital you want and what needs to be true for capital to invest. So, what is your team and traction? What is your addressable market? What is your path to profitability? What is your use of funds? I think all of these things, like, what are the key metrics, whether it's customer acquisition cost, lifetime value, customer churn rate. By the time you get in front of an investor, you probably need to have all of those things tight. I think you've also got to really think about, if I had 2 minutes with someone, what would I say? Like, what is my 2-minute elevator pitch that can attract their attention? What is my super concise 11-page pitch deck that will attract their attention? If it's full of words, if it's full of explaining, it's going to be challenging. I think one of the advice I always give to founders, the more you're showing and the more you're telling, the better it is. The more you're explaining what we might do or what we're going to do, you're probably losing. So very much focus on what have you done to date, who are your team, why are you the team that's going to win, what is the total addressable market, and then what is your traction, what is your proof of execution, what have you shown that you can do, what will your customers say about you, what will your shareholders say about you, I think these are all the critical elements as you think about going to market.
And what would be the red flags that make you not just even look at a deck or consider an entrepreneur who's pitching?
So I think I think you've got to be concise and intentional in your thinking. So the quality of your deck, I think, is important. I think your speed of response, like if you get an email from an investor at 5 o'clock on a Friday afternoon going, "I'd really like to see your cash flow," don't wait 2 weeks to respond. I think that's important. I think preparation in front, like, have you got a data room? Have you got all your documents? Have you got your agreements filed? So that then, and again, I'm talking at different stages of growth, but I think probably red flags would be any integrity or credibility issues. If you've got an investor who's not speaking well of you, go and fix that. If you've got an ex-founder that's not happy, go and talk to them. I think that just making sure that your DNA, be it your fingerprints or your footprint, wherever investors go to ask questions, your footprints of where you've been in the past and your fingerprints about what you're doing now will validate that you're a person of integrity, that you're trying hard, that you're working hard, you're trying to solve real customer problems. I think those things matter. So what are your customers saying about you? What are your investors saying about you? What will your team say about you? I mean, your biggest endorsement is probably the people working for you saying, this is a great place to work. We're super motivated. We're here for the long term. Whereas if an investor went to speak to your team and they go, "Oh, I'm just doing this because," I think people will really look at what are the team, what are the traction, and what are your fingerprints and footprints that you're leaving behind in the market.
I have to say, maybe you will correct me, but I assume it's much harder to attract money, whether to your fund or to a startup, being from African continent compared to being, in America or Europe or somewhere else, just because there might be some biases or assumptions people do from from America or Europe about the African startups. So perhaps could you debunk the most common ones that you were part of? Or that you heard, from people using?
I think that until we generate like the real financial risk adjusted returns, we're going to deal with an African discount. And this is why even as I say, we want founders to increasingly show and tell, not explain. I think there's an opportunity for the funds like us to also show and tell, to also deliver strong financial returns for investors. And the more we can do that, the better. So this is not just on the founders, this is also on the funds. The more all of us can work together to solve the right problems, to deliver risk adjusted financial returns, the more capital we'll crowd in without people saying, "Oh, but," so I think we can really all work together to put data in front of people that shows that we have got the very best entrepreneurs here on the continent. They are building robust and scalable businesses, and we can achieve strong financial returns. And every time I go back to Zambia, I'm always inspired by the resilience of the entrepreneurs there, because maybe there's less capital in the market. There's really strong business fundamentals. There's really strong unit economics. There's good gross margins. They're sweating their capital to take it further. The thing maybe what we've got to then do to support them is how do we widen that total addressable market? Because ultimately the buying power in Zambia is the buying power in Zambia. So if they want a sort of an exit that'll attract VC type capital, how do we think about scaling them out of Zambia potentially? But I think this is also where we all need to, one of the things we think about it, and this is where if you think about the Silicon Valley model, it's a lot more about a home run model. You have your one unicorn that pays for your fund, and then you don't mind failures. Whereas I think in Africa, the cost of failure is high. So how do we think more about averages? How do we model out funds that are successful with multiple 2 to 3 to 4 type exits? How do we blend equity with debt to generate strong financial returns? And then how do we really successfully narrate the impact narrative because ultimately, maybe on a pure financial return, we won't compete with Asia right now. We won't compete with America from a risk-adjusted return. So how do we really own that you can have real impact, but really good alongside really good financial returns, and just constantly prove that year on year on year, so that more and more capital flows into the market. I genuinely, when I started my entrepreneurial career, thought that team and traction would unlock capital, and to some degree it does. But I do think us consistently delivering exits and debt returns that will attract capital onto the continent is healthy. And that's also, I think it's increasingly important to build out the strategic influence and relevance of our founders, so that, they are built to exit and then they recircle back into the ecosystem as entrepreneurs. Because ultimately, a founder who's built and exited a business in Africa is not going to have the concerns you raised in your question. That person will know how good the entrepreneurs are here, how resilient they are, how innovative they are, how much they do in times of scarcity. So I think we've really, and this is where it's easy to maybe go, is the system broken, or are we just accepting that we're in quite an early stage of cycling capital or entrepreneurial type capital in the market, and we've just got to constantly and consistently beat and exceed expectations on how capital will perform in Africa to attract more capital onto the continent, or keep more capital in the continent, even, as another comment.
Earlier on, Brad, you talked about Success, which is one recent exit that you just had, the $10 million on a secondary deal. I also wanted to touch on failure. What has failure looked like as well for you, and what have been some of the lessons that you've picked up on with the fund itself?
I think that, again, if you look at the American VC model, failure is a feature, not a bug. So they don't, their model doesn't see failure as a bug. It's part of their process. I think because we don't have multiple realized unicorns in Africa, we might have businesses that have raised at unicorn valuations, but we haven't had sufficient businesses that have exited at unicorn valuations. I think this is where this concept of the camel comes along, that we do need our businesses to go further with less, which, because they go further with less, we all have to accept that our IRRs and our returns are not unicorn, they're more averages. So I think what we've seen is where businesses have potentially failed is where they've raised a lot of capital, they've focused on top line growth, and then when the follow-on capital to that next round doesn't come, they've over-engineered on cost, they've over-engineered on complexity, they've over-engineered on people, and then to rewind all of that and go back to a lean and mean gazelle type business that can jump from rock to rock taking advantage, they just don't have it in their DNA anymore. So I think what we're seeing is, and it's not always the entrepreneur's fault, it's often the board and the investors that have pushed them in that direction. So I think what we're seeing is the businesses that are capital efficient early, that have sound, strong executional DNA, that focus on growing profitably and sustainably, and then investing in growth, but when growth is sufficiently de-risked, are the businesses that do really well. I do think that it's the capital market is too nascent to think that if you grow on top line, that the bottom line will take care of itself. I don't think that plays out yet in our market sufficiently well.
And as founders grow, as the businesses grow, I know we are almost running out of time, but I would like to find out what your approach to this would be. As the businesses grow at different stages, right? The founder, I would like to be, needs to grow equally to sustain the business at that particular stage. How do you advise founders going about the process of their own learning and leadership journey as well? Because they need to be asking the right questions. They need to be thinking strategically about the business as well. How do you advise founders to go about their own learning and leadership journeys?
So I think you need to embrace that your journey is a journey of self-awareness. At all stage, your biggest priority is, before you manage others, you need to manage yourself. So how are you managing yourself? How are you managing your energy? How are you managing your development? how you're managing your wellness, how you're managing your relationship. I think all of these things are crucial. I think you should always go back to your why. So even with Zoona, our why was never to have control. Our why was never to be individually rich. Our why was we wanted to have the most amount of growth that we could. And that required us to bring in external capital, which meant that we had to take the view that it was not about control. It was about relevance. It was about performance. It was about a high performing culture. It was about us, my brother and I, no longer being the CEO. It was always everything we wanted to build was around growth. Now, if you want to be a king or a queen and you want to own everything about your business, then don't take other people's money. But if you want to grow and build something, it's like, do you want a big piece of a small pie or a small piece of a big pie? I think as founders and investors, you need to have these honest, candid conversations. And that's why I said the important thing is, where do you want to go as a founder? If you want to build $100 million business, you need to see that your board is not there to control you. They're there to amplify the business. They're there to add value. They're there to scale. You've got to build a team that you don't make every decision. So what decisions do you make? What decisions do others make? What are the decisions the board makes? So I think you've really got to think about what you want and where you're going and try and be super intentional about it. And then if you're growing a business 10 times a year, like how are you as a leader growing 10 times a year? There were definitely times at Zoona when I was the right leader for the business, and there were absolutely times where I was the wrong leader. I just didn't have the experience. So one of the things I think about in my career, and I encourage others to think about, is success breeds incompetence. And that might sound strange, but the more successful you are, the more incompetent you are, because by nature of success, you now have to do something new that you've never done before. So you are once again a beginner and you're incompetent. So I think just if you can take that approach, that you need to stay humble, you need to stay curious. If you think you're the smartest person in the room, or if you think you've got all the answers, you're probably in the wrong room.
So you are very successful, so you had to breed incompetence several times. So where do you go for inspiration? Where do you go to learn? What is your book, podcast, movie, news journal that you keep a track of?
So I really like First Round Capital. I think they've always got good stuff. I think there's always lessons and learnings and yes, books to read, startup books, business books. But I think where I often go to learn is to the coalface, is to the entrepreneurs. And I think, like I'm doing one of my walks tomorrow morning, like whatever anyone thinks they're going to learn from me, I'm going to learn from them. Like I am always incredibly inspired by the problems entrepreneurs in Africa are solving every day. So the entrepreneurs that have the willingness, the ability, the appetite, the skill, the perseverance, the resilience to go and do hard things, I find incredibly inspiring. And I know within myself right now, I don't have the energy levels to do 0 to 1 right now. My brother still does. He's out and out still in the trenches. Whereas I'm much more of a supporter and enabler to the entrepreneurs doing incredibly hard things.
And my last question, Martin, from my end.
Yeah.
Oh, go ahead. Go ahead.
No, go ahead, Kapila. Sorry. We argue sometimes like a couple. So go ahead, Kapila.
Yes, Brad, my last question is around, so we've talked about capital and quite a number of things, but we are aware that from a systematic perspective as well, there are quite a number of things that get in the way for entrepreneurs to really grow. So what do you think could be, and I'm speaking broadly about Africa, but of course I'm aware other countries might be well ahead. But what systematic changes or enabling conditions do you think would unlock the next wave of high growth African startups?
So I think one of the key ones, and this is where I'm always inspired by my partner Razan, who really thinks about this thing at an institutional level. So, she's starting to talk to pension funds here in Kenya, and I think again, this is conversations that should be having in Zambia. Is how do you unlock local capital to solve local problems at local rates? Like if you're borrowing in local currency from a local pension, or you've got equity from a local pension, like that level of risk for the entrepreneur and the resilience it adds to their business is huge. So I do think we really need to think about how do the pension funds, and initially they should probably invest in LPs. So how do they invest in the funds that have, because I think it's too big a jump for a pension fund to jump into a single entrepreneur deal. But how do you think about the pension funds providing local capital and local financing costs? Because all of your LPs like us have to get their capital from somewhere. So if our capital is coming from overseas, it's coming with overseas requirements, both in terms of risk adjustments, returns, etc. So how do we crowd in the local capital that then filters through to the entrepreneurs on the ground? Because if you've now got a single entrepreneur trying to build a business and learn how to hedge foreign exchange borrowings, that's a lot of complexity that someone starting a business in London is probably not dealing with. So how do we support the entrepreneurs by solving some of these macro problems so that they can focus on their customer and running their business?
I was about to ask you, where can people find you? But from the walk, from your forest walk on Fridays, if somebody wants to connect with you, is there also any other options?
Yeah, I mean, I'm on LinkedIn. I'm around. I visit Lusaka. So one of the things I have been reflecting on is in future when I go into anytime I visit an African city, is to reach out to the bongo hives of the world and just say, I am in town. I will be at their venue. Let's break bread and have a conversation. But yeah, if you're ever in Nairobi on a Friday, my WhatsApp number's on my LinkedIn post. You're always welcome to come for a walk in the forest.
Brad, it's been such a pleasure having you as our guest again. Super proud of your journey and the successes that you made and you continue making in the ecosystems. So thank you so much. And it was such a pleasure having you on the Beyond the Pivot podcast.
No, totally. And just, I think I mentioned in the email, just appreciation to both of you for providing this platform of shared learning and just a medium for entrepreneurs in Zambia and elsewhere on the continent to have access to different people's stories. We've all got our own stories, and it's a real privilege to be able to share mine. I don't take it lightly, and you don't often talk about yourself. So even just having this opportunity to engage and break bread gives me a way of almost being more concise in how I'm trying to think about the world and how I'm trying to show up in the African investment and entrepreneurial ecosystem as a value add and supporter of our growth on the continent.
We hope to have you soon again. Take care, everybody,
Well,
and have a great day and good luck building your future.
Cheers all. Go well.
Thank you for joining us on Beyond the Pivot. Remember to subscribe, follow, and share this episode with anyone passionate about Africa's future in business. For more stories and extra resources, visit tambotiseko.com. Until next time, keep pushing boundaries and shaping the future of African entrepreneurship.